What if I told you that while everyone's chasing the next dog coin, the real wealth transfer is happening in plain sight? We're witnessing the birth of a parallel financial system that could make traditional banking obsolete. And the window to position yourself is closing fast. Today, I'm revealing why decentralized finance could be the defining narrative of this cycle, and I'll walk you through our complete watch list of protocols that institutions are quietly accumulating. If you want to understand where the smart money is flowing before it's too late, smash that like button and let's dive in. What is DeFi? Let's cut through the noise. DeFi isn't some abstract concept. It's financial software running on public blockchains. Think about it. Smart contracts replace bankers and brokers. You can lend, borrow, trade, stake, and tokenize assets permissionlessly 24/7 from anywhere on Earth. No paperwork, no branches, no gatekeepers deciding whether you're qualified to access financial services. Code enforces the rules, you hold the keys, settlement happens in seconds instead of days. Fees drop by orders of magnitude, and here's the kicker. Every transaction is transparently recorded on chain for everyone to audit. This isn't theoretical. Right now, over $170 billion is locked in DeFi protocols, serving over 20 million users. That's bigger than the GDP of many countries, all running on smart contracts with zero CEOs and zero bank branches. DeFi is the open liquidity layer for the internet, and we are still in the first inning. Now, here's where it gets interesting, and why timing matters more than ever. Three massive forces are converging right now. And when I explain them, you'll understand why the smartest institutional investors are positioning heavily in this space. First, regulatory clarity in the US, the biggest financial hub on the planet, is arriving. And this changes everything. In Europe, MICA is already live. That's a comprehensive legal framework for crypto companies. Banks, funds, and fintechs finally have clear rules. They know what's allowed and what's not. In the US, the market structure bill is just around the corner. Once it passes, institutions get clarity on what counts as a security. For the first time ever, one of the world's two biggest financial regions is creating rules that actually invite institutions into crypto instead of pushing them out. This matters because institutional capital moves in billions, not millions. But it only moves when the legal path is clear. That path is being paved right now and could become law in the next 2 months. Second, follow the money. Hedge funds, family offices, and even pension funds are waking up to a simple truth. They can earn returns on-chain that are transparent, accessible 24/7, globally distributed, and orders of magnitude more efficient than traditional finance. But here's what makes DeFi different from other crypto niches. It speaks Wall Street's language. DeFi protocols generate real revenue. They have cash flows. They have metrics that traditional finance actually understands, such as total value locked, trading volumes, fees generated, and protocol revenues. Wall Street can use the same valuation models they use for traditional financial businesses. This makes DeFi familiar territory for institutions, and that familiarity lowers the barriers to capital deployment. They are not waiting anymore. They just needed two things: liquidity and legal clarity. And both are coming online right now. Third, and this might surprise you, retail investors are nowhere to be seen, and that's actually bullish. Last cycle was driven by retail speculation, meme coins, Discord pump groups, and lottery ticket mentality. This time, institutional capital is setting the tone, and retail hasn't shown up yet. Why is this good news? Because institutional money is patient money. Institutions don't rage quit on a 30% dip. They rebalance, they hedge, they hold positions for the long term. They bring billions in stable, strategic capital that builds sustainable growth, not just hype pumps. This means DeFi's growth trajectory could be healthier and more durable this cycle. It's being built on actual fundamentals, not just speculation. Put it all together, clear regulations opening institutional floodgates, programmable markets offering superior efficiency, and patient capital replacing retail FOMO. That's the setup for DeFi to lead this cycle's narrative. Now let's talk data, because this is where the story gets really compelling. Right now, DeFi protocols collectively hold over $170 billion in total value locked. That's the amount of capital sitting inside lending protocols, liquidity pools, and staking systems. Market cap across DeFi projects over $370 billion. On the user side, we've gone from a few thousand DeFi users in 2019 to over 20 million unique active addresses today. That's a 2000% increase in just 6 years. And we still haven't seen mainstream retail adoption. But here's what really matters: revenue. DeFi protocol revenue has grown from less than $30 million in 2023 to over $150 million in 2025. That's a 5x increase, reflecting real utility and real demand. This isn't just speculation. These are products people are actually using and paying for. And we're doing all of this without full institutional backing and without comprehensive regulations. Now look forward. Analysts project DeFi could hit billions in annual revenue by 2028. Some forecasts suggest trillions in total value locked by 2030. Why? Because institutions are planning to tokenize real-world assets. Treasury bills, real estate, corporate bonds, you name it. When that capital moves on-chain, it will dwarf today crypto-native liquidity. The trajectory is undeniable. DeFi is already a $150 billion parallel financial system. In the next 3 to 5 years, it could 5 to 10x. And unlike meme coins, this growth is backed by core financial infrastructure, stablecoins, lending markets, trading venues, derivatives, and real-world asset integration. This is why the smartest money in the room believes DeFi will define this cycle. The question is, will you be positioned when it happens? But before we dive into the watch list, let me share what keeps me up at night. Because if you're going to play this game, you need to understand the risks. First, regulation risk is real. Yes, clarity is coming, but governments could still crack down on specific protocols, especially around lending, derivatives, or stablecoins. One aggressive enforcement action could crater projects overnight. Second, smart contract risk. DeFi runs on code, and code can have bugs. We've seen multi-million-dollar exploits from simple programming errors. Even audited protocols aren't immune. Your capital is only as secure as the smart contract holding it. Third, liquidity risk. In stress scenarios, DeFi markets can dry up fast. When everyone wants to exit at once, slippage explodes and you might not be able to sell or withdraw at reasonable prices. And finally, macro headwinds. If traditional markets crash, if there is major banking crisis, or if geopolitical tensions explode, crypto is not immune. Risk assets sell off together, and DeFi tokens will get hit. This is why we don't go all in, ever. In our Freedom Capital portfolio models, only 15 to 20% goes into speculative plays. The rest protected in long-term positions that can survive crashes. Because here's the truth, it's better to make 5x on 20% of your portfolio than lose 90% trying to hit a home run. Capital preservation is the name of the game. Now let's talk strategy. We didn't just throw darts at a list of DeFi protocols. We applied a rigorous framework. We focused on protocols that solve real-world problems with real revenue models. We prioritize ecosystems that institutions actually care about, such as Ethereum, Solana, Base, and Ton. Why? Because when capital flows, it flows through liquid, battle-tested chains. We looked for projects with strong fundamentals, proven product market fit, growing user bases, transparent metrics, solid security track records, and teams that can actually ship. But we also balanced that with upside potential. Some of these are blue chips, such as Aave or MakerDAO, offering low but more stable returns. Others are emerging protocols with 5 to 10x potential if execution goes right. Alright, now for what you've been waiting for, the top 10 protocols that could define DeFi this cycle. For each one, I'll break down exactly what it is, why it matters, the risks you need to know, and what metrics to watch. Let's go protocol by protocol. First, Black Hole Protocol. Avalanche's liquidity aggregation play. What is it? Black Hole is Avalanche's central trading hub, a decentralized exchange designed to pull all the chain's liquidity into one place, community controlled with no insider allocations. Why it matters? Avalanche's DeFi is scattered across multiple platforms. Black Hole concentrates liquidity for better prices and efficiency. With Avalanche's foundation backing, it could become the default trading venue. The risks: complex infrastructure means higher security, it directly competes with established players, and success is tied directly to Avalanche's growth. What to watch? Track total value locked and daily trading volume. Are new projects launching tokens here? If they are capturing the majority of Avalanche's activity, the flywheel is working. Second on the list, Ston.fi, the Ton ecosystem DEX with Telegram integration. What is it? A decentralized exchange built directly into Telegram. Trade crypto without leaving your chat app. Runs on Ton blockchain with hundreds of millions of potential users. Why it matters? This removes all friction. No complex wallet, no leaving Telegram. When retail returns, they will be on Telegram, and Stun.fi is their gateway to crypto trading. The risks: intense battle with DDoS for Ton dominance. Token unlocks could create selling pressure, very low token trading volume, and Ton platform risk and regulatory uncertainty around Telegram. What to watch? Are they beating DDoS in total value locked and volume? Track Telegram mini app monthly active users, and if they overtake DDoS, they have won Ton. Third, DDoS, Ton's pioneer DEX. What is it? Ton's first major decentralized exchange with over 1,000 trading pairs. Simplified user experience with dust token that earns you platform fees when staked. Why it matters? First mover advantage with deep ecosystem relationships. Their technology makes trading easier by hiding complexity, and broad token selection keeps users on Ton. The risks: fighting well-funded Stun.fi for market share, limited treasury for marketing, and ceiling limited by Ton's overall performance. What to watch? Weekly market share versus Ton. How much dust is burned and staked? If they hold TVL and grow fees, they remain Ton's foundation. Fourth, Aerodrome Finance, Basis Chain Liquidity Hub. What is it? Basis Chain dominant decentralized exchange where you lock tokens for voting power, direct rewards to pools, and earn 100% of trading fees from your votes. Why it matters? It captures dominant share of Basis' explosive growth. Every new project needs liquidity, they will come to Aerodrome, and built by a proven team. The risks: weekly token rewards create sell pressure, Uniswap and Curve competition, and dependent on Basis' continued momentum. What to watch? Are weekly fees exceeding token emissions? Above 1 for multiple weeks means sustainable economics. And track Basis' market share from Ethereum Layer 2s. Fifth, Camino Finance, Solana's DeFi super app. What is it? Solana's all-in-one platform. Automated yield, lending markets, and borrowing. All simplified into one-click interfaces managing billions in user funds. Why it matters? Makes Solana DeFi accessible to everyone. Sophisticated infrastructure for institutions and simple interface for retail. Also positioned as the hub for incoming Solana capital. The risks: Solana network outages hurt everything built on it, and token valuation captures still evolving. Moreover, there is heavy competition if Aave deploys aggressively. What to watch? Total value locked growth towards $5 to $10 billion, and what percentage of Solana lending do they control? Also, watch for institutional partnerships. Over 60% lending share equals dominance. 6. Aave, the blue chip institutional lending standard. What is it? The largest decentralized lending platform. Deposit crypto to earn interest or borrow against your holdings. It operates across all major blockchains with their own stablecoin called GHO. Why it matters? When institutions enter DeFi lending, they go to Aave first. They have the strongest brand, widest reach, and proven security. GHO could multiply protocol's value if adopted. The risks: billions locked means one bug could be catastrophic. Also, market crashes creates cascading liquidations, fierce stablecoin competition, and rising regulatory scrutiny. What to watch? Borrowing demand and utilization rates, GHO adoption and peg stability, and institutional pool launches. Rising revenue with stable risk equal health. 7th, Marinate Finance, Solana's OG liquid staking protocol. What is it? Stake SOL to earn rewards while receiving MSOL, a liquid token you can trade or use elsewhere. Spreads stake across 170 plus validators for Solana's security. Why it matters? Liquid staking is DeFi's backbone. AMSOL is used everywhere as collateral. It improves Solana's decentralization and token buybacks reduces supply. The risks, G2 offers higher yields through MEV. Also, Solana platform dependency. On top of that, token utility is still maturing. Regulatory scrutiny on staking services. What to watch? Market share versus G2, liquid staking penetration rate, MNDE token buyback frequency on SolScan, and wallet integrations. Growing adoption equals growing moat. 8. Radium, Solana's AMM and launch hub. What is it? Major Solana DEX deeply integrated with Jupiter aggregator. It provides liquidity, launches new tokens, and distributes fees to stakers. Buybacks have destroyed 10% of their supply. Why it matters? It captures a huge Solana volume through aggregator routing. It also has high volumes, which means high fees for stakers. And also deflationary tokenomics from buybacks. The risks, competition from Orca and order book DEXs. Also, in 2022, the hack damaged their reputation, but it is now fixed. It is also dependent on Jupiter for volume. What to watch? Jupiter routing share on major pairs, concentrated liquidity total value locked, and buyback frequency. If they win routing during volatility, engine is healthy. Number 9, Clearpool, institutional unsecured credit markets. What is it? Marketplace where institutional borrowers get unsecured loans from crypto lenders. Borrowers are identity verified and lenders see who they are lending to. Expanding into business financing. Why it matters? It brings Wall Street to DeFi. Institutions get 24/7 capital access, and lenders earn yields uncorrelated to crypto prices. It also bridges TradFi and DeFi. The risks, borrower defaults mean lender losses with no collateral. Also, there is unclear regulations. On top of that, there is competition from Maple and TrueFi. Liquidity can dry up in stress scenarios. What to watch? Total loans originated and outstanding, utilization rates and default rates, because credit performance is everything. On top of that, watch institutional adoption because consistent borrower relationship signals trust. 10 and final, Pendle, the yield trading automated market maker. What is it? It separates your crypto's yield from its principal and trade them independently. It locks in fixed rates and amplify returns. It brings traditional bond markets to decentralized finance. Why it matters? Because fixed income markets are worth trillions in traditional finance. Pendle brings that sophistication on chain. Treasuries hedge, farmers lever yield, and institutions price rates. The risks, it's complex for retail users and it needs deep liquidity across many maturity dates. It's also dependent on underlying protocols and derivative regulations are unclear. What to watch? Total value locked and trading volume growth, liquidity depth on major pairs like staked ETH, and exchange integrations. Multiple maturities with good liquidity equals product market fit. Those are the top 10 projects from the watchlist. Now, how do you use this watchlist? Here's the Freedom Capital framework. First, categorize by risk. Blue chips for stability, ecosystem dominators for growth, and speculative plays for highest upside, and allocate accordingly. Second, diversify across narratives. Don't overload one chain or category. Third, monitor metrics. TVL, revenue, market share, execution, etc. Fourth, scale strategically. Dollar cost average in and take profits systematically. And fifth, never more than 15 to 20% in speculative DeFi. Capital preservation keeps you alive to win. We've just covered massive information and you won't remember it all. That's why we have created a comprehensive watchlist document with full breakdowns, risk metrics, and entry-exit targets. Same concept we use at Freedom Capital portfolio models. Completely free, link in the description below. Over the next few weeks, we are dropping deep dives on selected protocols, fundamentals, tokenomics, competitive and community analysis. Hit that notification bell if you want to stay updated. For hands-on guidance, check our Portfolio Strategies service where we provide weekly analysis, portfolio models, due diligence, and one-on-one support. Link in the description. We are in the accumulation phase. Institutions are building positions. Protocols are shipping infrastructure. Regulations are creating green lights. And retail hasn't arrived yet. This is your window to position before the crowd. Drop a comment with which protocol you're most bullish on. If this helped you, smash that like button and share it with someone who needs to see where the smart money is flowing. As always, thank you so much for tuning in, and I'll see you in the next one.